keep doing the same thing, but we are going to now add some various assets and equipment and intangibles. So we don't just have one we're amortizing, we're going to do a couple now.
Okay.
Everything's still the same, but we're just adding to the mix here. So for number 15, it says, on January 1st, 2014, Ridge Road Company acquired 20% of the voting shares of Sauk Trail for $2,700,000 in cash. Both companies provide commercial internet support services, but serve markets in different countries or different industries. Ridge Road made the investment to gain access to Sauk Trail's board of directors and thus facilitate future cooperative agreements between the firms. Ridge Road quickly obtained several seats on Sauk Trail's board, which gave it significant influence, and that means we have to do the equity method. So they purchased 20% for $2,700,000. Then it goes on to tell us, how should Perez report, excuse me, I'm in the wrong one. There. The January 1st, 2014 carrying amounts and corresponding fair values for Sauk Trail's assets and liabilities are shown. Also, as of January 1st, 2014, Sauk Trail's computing equipment had a 7-year remaining estimated life. The patented technology was estimated to have a 3-year remaining life, and the trademark's useful life was indefinite. Okay, we're not total crazy. Ridge Road attributed to goodwill any unidentified excess costs. During the next 2 years, Sauk Trail reported the following net income and dividends. So we've got 3 different parts we're going to answer here. The first says, how much of Ridge Road's $2,700,000 payment for Sauk Trail is attributable to goodwill? So we're going to determine the $2,700,000, and it shows us what the book values are here, but it also then shows us what the fair market values are. So the excess between book and fair market, we're going to have to take our share of that and treat it accordingly, as we're supposed to. So let's start. First step is we're going to talk about what we purchased the company for. So we started by purchase price, or you can call it acquisition price, of $2,700,000. Okay?
Yeah.
Now, the book value acquired was, if we add 110 plus 5,000,000, 100 plus 150 minus 185, what do we get? Here, let me, 5, 210, 360, 360 minus 185, let me just, 5,360 minus 185. So this is 5,175,000, and our ownership percent is 20%.
It's 40%. No, I'm sorry, what problem? We're on 15.
15.
20.
Okay.
Right.
So if we take this times 20%, the amount of book value we acquired in this arrangement is $1,035,000. Let me show you how I figured that. It gave us our carrying amounts, which also means our book value. So our cash plus the equipment plus the patented technology, the trademarks, minus the liabilities, because we're doing net, gives us the figure of $5,360,000. Okay? Am I saying that right? But if we, what am I doing? 5 million, excuse me, what is the 185?
Yeah, so 5,360,000 is the total of the assets, and then you minus the 185.
I minus the liabilities, yes.
Okay.
So then I took the net assets times 20% gave me the $1,035,000. So the excess purchase over book is $1,665,000, right?
Yep.
Now, we know this is how much we're paying above and beyond what the book shows. But if we go back here, we know the computing equipment really is $700,000 higher than what the book shows.
Right.
The patented technology is a lot higher. Our trademark is a lot higher.
Yeah.
So we're going to show this $700,000 plus this $3,900,000 increase, plus this $1,850,000 increase times 20%. Does that make sense?
Yes.
So we are going to go here and show the excess fair value of the computer equipment. It was $700,000 times 20%. Our share of it is $140,000. The excess fair value of the patented technology is $3,900,000 times 20%, or $780,000 times 20%, okay? Then our excess fair value of the trademark is $1,850,000 times 20%, which is $370,000. So if we add all of these excess values that are allocated to us, we're at $920,000. Okay? Now, what is left of this $1,665,000? So basically, we've got an extra $745,000 here, don't we? 780. No, I'm sorry. We've got 745 here. So trademark. I just screwed something up. Trademark is $1,850,000 times 20% is $370,000. So $370,000, $140,000, $780,000 gives me $1,290,000. What is the leftover amount from the $1,665,000, which is the excess, divided by or subtracted by what we've already taken into account? $375,000 is what's left. So we go back to the problem, and I think it says Ridge Road attributed goodwill to any unidentified excess costs. So because we still have sitting out here $375,000, that's going to be goodwill.
Okay.
Okay? Does that make sense?
Okay.
And so that allows us to take into account the entire $1,665,000 excess. Okay?
Yeah.
So here's how we compute the various excesses. This $140,000 computing equipment has a useful life of 7 years, which basically is $20,000 a year, right? The patent of $780,000 has 3 years left on it, which is $260,000 a year. The trademark is indefinite, and the goodwill is indefinite. So the only amortization we're going to do here would be $280,000 a year. Does that make sense? So the question was, how much of Ridge Road's $2,700,000 payment for Sauk Trail is attributable to goodwill? $375,000. But we had to do all of that to get there. Next, B says, what amount should Ridge Road report for its equity in Sauk Trail's earnings on its income statement for 2014 and 2015? It's not asking what on the balance sheet. It's asking equity. How are we going to compute that? Well, we're going to take into account their share of income. What is their share of income for 2014?
$1.8 million was the total.
Good.
So whatever, 20%.
Times 20% in 1.8 million. So we're in equity going to show 360,000. Now, equity does take into account what we need to show for amortization.
Right, so we need to reduce it. Right,
We need to
by
reduce it.
280.
Amortization for 2014 of minus 280. So our equity in the 2014 earnings of the company Sauk will be 80.
Okay.
Then it asks us, what is the equity for 2015? So our equity in 2015 is going to be done just like this. Equity income accrual for 2015, it was $1,985,000 times 20%, or
397,000.
397. We still need to take our amortization
Which is still the 280, right?
for yep. So equity in 2015 earnings for Sauk, 117. Now it asks us, what do we show as the asset on our books for Sauk on the balance sheet? This is where we're going to take and subtract the dividends.
Okay.
Okay? So the question is, What amount should Ridge Road report for its investment in SALT on its balance sheet? Well, we start with the purchase price, acquisition or purchase price of $2,700,000. Then we're going to take in 2014 the earnings of $80,000 minus our dividends so they paid out dividends
2014 of 150,000.
150,000
20% is 30,000.
times 20% minus 30. So our investment in SALT as of 12/31/2014 is $2,750,000. Okay? Now we start the year with an investment of $2,750,000. So for 2015, we're going to start with investment in SALT 12/31/14 of $2,750,000. Then we're going to add our income of $117,000. Okay? Earnings less our dividends, which is 160 times 20% or 32,000. Here is our investment in SALT 12/31/15. $2,835,000. So the key is understanding what comprises the asset portion and what comprises the equity. That make sense?
Yes.
Now, we're going to continue on and look at number where are we?
We finished 15. 16 is a homework problem.
Okay. There we go. So we finished 15. I'm going to do 16 and then 17. Okay?
Yeah.
So number 16 states okay. Number 16. Sorry. Find it. Okay. 16 says on January 1st, 2014, Allison Inc. paid $60,000 for a 40% interest in Hollister Corporation's common stock. This investee had assets with a book value of $200,000 and liabilities of $75,000. A patent held by Hollister having a $5,000 book value is actually worth $20,000. This patent has a 6-year remaining life. Any further excess cost associated with this acquisition is attributable to goodwill. During 2014, Hollister earned income of $30,000 and declared dividends paid of $10,000. In 2015, it had income of $50,000 and dividends of $15,000. During 2015, the fair value of Allison's investment in Hollister had risen from $68,000 to $75,000. Assuming Allison uses the equity method, what balance will appear in the investment in Hollister account as of December 31st, 2015? So we are looking for the asset in the asset shown on Allison's balance sheet for Hollister. Okay? So the first requirement is to determine the investment in Hollister. So we're going to start that by taking the purchase price. Purchase price of $60,000. Now it told us that the book value
It's 200,000, liabilities are 75.
200,000, 125 times 40% is
50,000?
50,000. So the excess purchase over book is 10,000.
Is there goodwill? Yeah.
But it also tells us that the patent that has a book value of 5 was actually worth 20,000. So that's excess of 15,000, okay, at 40%. You see what I'm doing? We have to allocate that portion.
Right.
So the excess of the patent is 15,000 times 40%, or 6,000, okay? So we had excess of purchase price over book of 10. If we use 6 for this, then our goodwill has to be 4.
Oh, it's the net of that.
The net of that. Because this is what we know our excess is.
Okay.
It gives us the information to say our patent was understated, undervalued.
Oh, undervalued.
It was undervalued. It had a book value of 5, but it's really worth 20. So 15,000 times the 40% gives us our 6.
Okay.
And it has a 6-year remaining life. So we're going to take this, divide it by 6 years, and allocate 1,000 a year in amortization. Our goodwill of 40,000 is indefinite, so we're not going to allocate that one. Okay? Now, to figure out the investment in, what's the name of this company? Hollister?
Hollister's.
Yep, Hollister. Investment in Hollister. We show the purchase price or acquisition price of $60,000. Then we take the income that's allocable to us in 2014. The income accrued is going to be the 30,000 times 40%. They paid dividends of 10,000 times 40%. Okay? So income is 30 times 40%, or 12,000. The dividends will be the 10,000 times 40%, or minus 4,000. Then we have to take our amortization for 2014 of 1,000. Now, the requirement was, what is our investment as of the end of 2015? So now we need to go and look at the income. For 2015, it had 50,000 of income and 15,000 of dividends. Okay? So we're going to say income accrued, 50,000 times 40%, or 20,000. The dividends in 2015, God, I'm so slow, were 15,000. So it would be 15,000 times 40%. What am I doing? Or 6,000 bucks, which I need to subtract. We also need to take our amortization for 2015 of 1,000. And so our investment in Hollister as of December 31st, 2015 is 80,000. Is it making sense to you?
Yeah, the patent thing threw me off because I was thinking that
Should all be goodwill?
you should add it in. I was thinking that when they used the word, was it undervalued, my brain went additional.
Well, we did though. We did add in the patent here.
Here, yeah, that would be.
We added it because our excess, instead of all of this 10,000 just going straight to goodwill,
Right.
we had to account for
Count to the
some under
patent.
patent.
Yeah.
Now the next one says, if Allison uses what we call fair value accounting, what income from the investment in Hollister should be reported for 2015? We have not discussed fair value yet, but we're going to bring it up here. So let's go to the book. Let me find. On page 22, how fair value works. So let's go to page 22. And fair value reporting for equity method investments. So we've only been dealing with the equity method. So now we have an option to use a method called fair value, under which an entity irrevocably elects fair value as the initial and subsequent measurement attribute for financial assets and liabilities. Under this value option, changes in the fair value of the elected financial items get included in earnings. Among the financial assets available for the fair value option were investments otherwise accounted for in the equity method. So in this example, Citigroup has reported at fair value certain of its investments that previously were reported using the equity method. In its 2012 annual report, Citigroup noted that certain investments in non-marketable equity securities and certain investments that would otherwise have been accounted for using the equity method are carried at fair value, since the companies elected to apply fair value accounting. Changes in fair value of such investments are recorded in earnings. Many other firms have been reluctant to elect the fair value option for their equity method investments. Firms that use this method simply report the investment's fair value as an asset and changes in fair value as earnings. As such, firms neither compute excess cost amortizations nor adjust earnings for intra-entity profits. Dividends from an investee are included in earnings under the fair value option. Because dividends typically reduce an investment's fair value, an increase in earnings from investee dividends would be offset by a decrease in earnings from the decline in an investment's fair value. So, by illustrating this, January 1st, Westwind pays $722,000 in exchange for 40,000 shares. Armco has 100,000 common shares outstanding, so they're purchasing 40%.
Okay.
The majority of which continue to trade on the stock exchange. During the next 2 years, Armco reports, tells us the net income, the cash dividends, and the fair value of the common shares at the end of each year. If Westwind elects to use fair value accounting, it's going to make these journal entries in order to do this. So as you see, under the fair value approach, we're going to the initial purchase price of $722 is the same. We show investment as an asset. Then when we receive the dividend, we debit our cash and we show dividend income as a revenue. Then, to recognize the change in the value of the assets. The value of the assets as of the end of December 31st are $1,900,000. We own 40% of it. So $1,900,000 times 40% is 3876, 760,000, right? 40% of 1,900,000 should be 760,000. So if we purchase the company for 722,000, at the end of the year, the difference, 760,000 minus the 722 that we purchased it for, is going to be added to the asset as 38,000, and we also have to show it as income. So in ways this is easier, because under the equity method, at the start we allocate the purchase price to all the excesses and then amortize it. Under this method, we just keep it simple and we just adjust. We increase the asset account, but then it goes to income. We don't deal with the earnings ever. All we're showing as income are the dividends and the changes in fair value. Then in the next year, they reported dividends of $25,000, so 40% of $25,000 we show as income. Now the assets show $1,870,000. They were at $1,900,000. So that $30,000 difference times 40% our portion, it's going to be a loss now, isn't it? So we're going to show a decrease in our investment account, and we're going to show a debit to investment loss. Okay? So really, this is a lot easier. Very different, but a lot easier. So let's look at this next problem.
Are we looking at the next problem or finishing 16 up?
16, I'm sorry.
Okay, that's okay.
And
So,
16. When it says Allison uses the fair value accounting, what income from the investment in Hollister should be reported for 2015? Okay? What's going to be reported here for 2015? The dividends are 100.
Dividends were 15,000.
15,000 times 40%.
Right. Which
Oh,
was
that's in 2000.
Wasn't that 2015?
15, yes. 15,000 times 40%
Is 6,000.
is 6,000. And then, do you see how it says during 2015, the fair value of Allison's investment in Hollister had risen from 68,000 to 75?
Yes.
So we'll have to show that as income also. That 7,000 is going to be shown as investment income. Okay, so let me just put it in here. So what we would do for Part B, under the fair value method for income, we would show the dividends allocable would be 15,000 times 40%, or 6,000. And the increase in value, in the fair value, is, it's now 75, it was 68, our share. So that 7,000 needs to be reported. So we'll show investment income under the fair value accounting for 2015 is 13,000. Okay?
Okay.
Very different. But there are various ways in which companies can elect to report.
Is it partially due to taxes?
No.
Or kind of the type of company that they are?
It's just based on which manner they wish to record it.
Okay.
So this is an option that just came into being recently.
Oh, okay.
So that is number 16.
Yeah, that's the Part B. Yep.
Let's look at 17. Number 17 says, on January 1st, 2015, Alamar Corporation acquired a 40% interest in Burks Inc. for $210,000. On that date, Burke's balance sheet disclosed net assets with both a fair and book value of $360,000, so nothing changed. During 2015, Burke reported net income of $80,000 and declared and paid cash dividends of $25,000. Alamar sold inventory costing $30,000 to Burke during 2015 for $40,000. So a 25% gross profit rate, because I'm taking the gain of 10 divided by 40 gives me 25%. Burke used all of this merchandise in its operations during 2015, so we don't have to do anything about it, do we?
Correct.
Prepare all of the journal entries to apply the equity method to this investment. So let's just kind of look at what we're going to do. Let's set it up. We bought it for $210. The assets are at $360 in whole, so we'll calculate our 40%. So the acquisition price is $210. The book value of Burke's stock is $360,000 at 40%. 144,000. The excess of book or purchase over book has to be goodwill. Because they didn't tell us anything, did they?
No, they didn't.
So it has to be goodwill of $66,000. We're not going to amortize that, are we?
Mm-mm.
So at least we kind of know what we need to do here. There's no annual amortization. So journal entries. The first journal we need to do is show we purchased the investment.
Okay.
So we'll debit our investment in Burke for $210,000, and we'll show our cash or a payable for $210,000. Then we need to show the income from this investment. The income for the year was $80,000. So we'll show our investment in Burke, $80,000 times 40%, or $32,000. And we'll credit our equity in investee income of $32,000. Then we need to show our dividends. Our dividends were
I'm looking at the wrong problem. 25,000.
okay, 25,000 times 40%. So dividend receivable.
Like 10,000.
And we're going to reduce our investment in Burke by 10,000, aren't we?
Yes.
Then, when we show we receive those dividends, we'll just show a debit to cash and a credit to dividends receivable. That's it. We don't need to perform any allocation because there's nothing to allocate. Goodwill has an indefinite life. Okay?
Okay.
Now, did I tell you we were going to do 18?
Yeah, I think 18
Okay.
is the.
Homework? Okay, good.
Yeah, 16, 18, 19, and 32 are homework.
Okay, so 18. Austin acquired 10% of McKinsey Corporation on January 1st for $210,000. Although McKinsey's book value on that date was $1,700,000. McKinsey held land that was undervalued by $100,000 on its accounting records. During 2014, McKinsey earned a net income of $240,000 while declaring and paying cash dividends of $90,000. On January 15th, Austin purchased an additional 30% of McKinsey for $600,000. McKinsey's land is still undervalued on that date, but then by $120,000. Any additional excess cost was attributable to a patent with a 10-year remaining life for the first purchase and a 9-year life for the second. The initial 10% investment had been maintained at cost because fair values were not readily available. The equity method is now going to be applied because it's more than 20% and they can have significant influence. During 2015, McKinsey reported income of $300,000 and declared and paid dividends of $110,000. So we need to come up with all the journal entries here. So let's just take what's happening. Let's take that first purchase. They initially purchased 10% of the company for $210,000, correct?
Yeah, that's the first thing.
So we are going to start by showing the purchase. I'll show this as the first purchase in January of 2014. We're going to show the purchase price of the stock, $210,000. Now the book value is $1,700,000 at 10%, or $170,000. So we have excess of purchase over book of $40,000. Now, it told us then that the land was understated. It told us the land was undervalued by $100,000 on its accounting records. Again, we own 10%. So the land of $100,000 at 10%, or out of this excess of 40, 10 of it is going to be applied to the land. What does that make that the excess amount? 30,000 we have to deal with, right?
Right.
It told us that the extra 30,000 said any additional excess cost was attributable to a trademark with a 10-year remaining life for the first purchase. So this excess cost of 30,000 is a trademark, 30,000, because this 40 is a summation of those two numbers, and it has a 10-year life, which means 3,000 a year. Correct?
Correct.
So, for the first year, the book value shows the solution manual's wrong. So the book value shows the purchase price of Mackenzie.
Yeah.
So the book value, oh, this is of Mackenzie. Okay. So the book value shows $1,700,000. They also added income of $240 and subtracted dividends of $90. This is not asking us what our investment in Mackenzie is. We just need to come up with what the book value is, so this next purchase, we know what the book value is. Okay? So our book value in Mackenzie, or Mackenzie's book value, as of January 1st, 2015, is going to be $1,850,000. We need to know that so we can allocate any excess costs. That's why this is new this time. Now we got to deal with our second purchase. Our second purchase was we purchased second purchase of purchase of stock for $600,000, and now we own 30%, right?
Yeah.
Well,
Or is it 40%?
it's 40%. We bought another 30%.
Okay.
So the book value of Mackenzie is the $1,850,000 times 30%, or $555,000. We now have an excess of purchase over book, and that excess of purchase over the book is $45,000. Now it told us that any excess is related,
To the trademark.
and isn't there some land?
Oh, it doesn't say anything about the land.
It
the second
says-
time around, does it?
The initial 10% investment has been maintained at cost.
Below fair value is not readily available.
Mackenzie's land is still undervalued on that date.
Okay.
but then it's undervalued by 120,000. You see that in the very middle?
Oh, yes.
So now we have to allocate what we need to the land. So it's undervalued by 120. So cost assigned to undervalued land is 120 times 30%, 36,000, and that difference is now going to be the trademark, right?
Yes.
Or
9,000.
9,000. So 36,000 is going to go to the undervalued land. 9,000 is going to go to the trademark, and the trademark has a useful life
Now of 9 years.
of 9 years.
Second.
So this 9,000 is going to be amortized over 9 years, which is basically 1,000 a year.
Yeah.
Okay, so we had to calculate all that to understand our journal entries. So our journal entries are going to show, what did they tell us our journal? Prepare all of the 2015 journal entries. Okay, so we don't need to deal with the 2014 journal entries. They want us to deal with the 2015 journal entries. So the first thing we're going to do is show our purchase of the stock.
And that's just the second purchase,
Mhm.
right?
Investment in McKinsey of 600,000, and we either have a cash or a liability, 600,000. Then we need to show an adjustment
To the book value, don't you?
to restate reported figures for 2014 to the equity method. Because we didn't need to use the equity method first, now that we have significant influence, we have to restate
Oh, that's right.
2014 to the equity method. So the way in which we're going to do that is we initially had the first year they earned net income of 240,000. Okay?
Mhm.
We have a 10% ownership in that.
Right.
So we're going to need to show that investment of 24,000 there. They paid dividends of 90,000. 10% is 9. So we're going to have to subtract 9,000 in dividends. And then the amortization on that first purchase was 3,000. So we're going to need to now create the equity method because they just recorded everything at cost and let it be.
Okay.
Now that we now have a share of this significant influence, we need to now show the investment in McKinsey is going to be 10% of 240,000, right? Plus 10%
The dividend.
of, or minus, how about, minus 10% of the dividend minus our $3,000 allocation. So 24,000 minus 9,000 minus 3,000 gives us 12,000. Since that happened in the previous year, but we need to restate it now, instead of crediting equity in investment,
Okay.
we're going to credit a retained earnings. Prior period adjustment. So basically, they're going to have to go back and show that income in 2014. Okay? Make sense?
Yeah.
Now, we'll now also need to show the percent of income that we have to account for 40%, and their income this year was 240,000, no. $300,000 and dividends of 110. So we need to show our share of the income, investment in McKinsey, and we'll call it equity, income, investment in McKinsey. So we'll figure this out by our 300,000 times 40%. You know what I'm saying? The income attributable and at 40%. So that will be 40% of 120. Then we're going to need to show the portion of the dividend, and it paid dividends of 110,000. 40% of those dividends will be 44,000. So we'll have here a dividend receivable, and we're going to reduce our investment account, right?
Yeah.
Then when we receive the dividend, we'll debit our cash, credit our receivable. Okay? Then we have an amortization. Our amortization needs to now combine the 1,000 for the second purchase plus the 3,000 for the first purchase, or 4,000. So that allocation is going to reduce our investment and reduce our equity income. So equity in McKinsey is 4,000, and we'll do the same thing, investment in McKinsey, 4,000. So we've added another piece to this. It's the same thing, but they changed in midterm. So we had to go back in our books and figure out in 2014, if we would have done the equity method to begin with, what would it show? Okay? Because just owning 10%, they just show any dividends they receive, that's all they'll show.
Right.
So we needed to adjust it so it reflects retroactively the equity method. So, next, let me just see here where we're